All right, welcome to Peace of Mind Radio. I am Brian Ramsey. That is Eric Douglas. And over here is Chris Vaughn. And no, we don't wear the same thing. I think I say this in every video.
You say it every time, yeah.
We don't wear the same thing. We just happen to do two in a row.
I have a sweater in my office. I should have grabbed that. I didn't even think about it.
I didn't have any. Well, I could have taken this thing
Take the
off.
sweater off.
Yeah, anyway. All right, so if you're watching and you watched last week, or if you're watching this week, you watched last week, and you're like, those dudes have on the same thing they had on last week, you're right. It just happens that we shoot these things back to back.
We had lunch in between, right?
We did have lunch, yeah, because it takes forever for this thing to download. But anyway, that's a whole that's
another podcast.
That's another podcast on that. Anyway, so we had a break, so we kind of chatted about what we want to talk about, and this is a pretty interesting topic because it comes up occasionally, but it's more important this year, and that is the tax filing deadline was extended.
Yep.
Right, extended to what?
May 17th, because the 15th falls on a weekend, so they always go to the next Monday.
Yeah, and there's a whole different podcast on why they extended it,
Yeah.
because there's all these amendments that they have to do, and anyway, we won't go into all that. But what we thought was pretty relevant was, from time to time, we'll have clients that come in that say, hey, I want to make a contribution to my IRA or to my Roth, and what we wanted to talk about was all the things that you could be doing from January 1 until the tax filing deadline, which can be extended, all the things you can do to make contributions for last year.
Yep.
Right? So that's kind of what we're going to talk about. We're just going to round robin it and talk about, how we position that with clients. What are some of the topics that we talk about with clients? So talking about make contributions for this year or for last year and this year. So with that being said, why don't you guys take one and we'll just kind of round robin the whole thing.
Well, I mean, the obvious one is when you're dealing with traditional IRA, Roth IRA contributions, most people are aware you can contribute $6,000 per year if you're under age 50. And if you're 50 or older in that calendar year, then it's $7,000 per year. Now, that's total. That's not $7,000 in each one of them.
That's right.
But what's neat about it is you can make that contribution up until the tax filing day of the next year. And people don't realize that. People don't realize that stay-at-home moms, for example, can also contribute. So the tax deadline issue is always you should max out last year before you contribute to this year. And
Why would you do that?
The reason for that is you're limited to $6,000 or $7,000 a year. So what happens if you've got some extra money? It's say March, and you've got an extra $1,000 you can put in, and you have that much gap for last year. You always want to use last year. What happens if you have a windfall in November and you want to max out your IRA for this year with that windfall? If you'd put it in last year, you have that opportunity. If you don't, then you're kind of capped out. And that's why you should always max out the previous year when you can.
Eric, I'm going to throw a question at you. It's a curveball. I think you got the answer, though.
I haven't played baseball in a long time, Brian. Come on.
Oh, that's right. Hey, baseball at Bellarmine, by the way, right?
Yeah, once upon a time. D1 now. D1.
Yeah.
Is that just basketball, or is
No,
it's
all
that's
sports.
all sports,
The whole
isn't it?
It's all sports, yeah.
Okay, cool. Yeah, that's awesome. That's
Baseball
awesome.
team's off to a great year.
Are they really?
I think so, yeah.
Awesome, man. Well, at least they're playing. I guess that's what. All right, we digress. All right, so here's the question. So there is. So if I'm an individual, okay, so I'm not married, and I make right around, let's say 130, 140, and I'm not real sure. Whether I can make a Roth contribution. Is that something that kind of plays into this? Hey, wait till after the first of the year. You find out how much you're going to make or what your adjusted gross income or modified adjustment gross income, and then make contributions. So maybe touch base on that.
Well, that's the kicker, too. You just said it. What's your modified or what's your adjusted gross income? So if you're making about $130,000, you're right there at the limit for a single filer for what you can contribute per year to a Roth. So if you make anything more than that as a single individual filer, you're not going to be able to contribute directly, I should say.
There it is.
You can always do something,
do
do the back doors, and we'll talk about that in a minute.
And what's the amount for marrieds?
For married, it starts phasing out at $200,000 or at 208. It just raised it. It's 200. It's 209 for 2021. It was 208.
Okay, there you go.
You're officially 100% phased out at that point. It starts phasing out at 190 something.
Yeah.
Whatever. It's high 190s for married, finally, jointly. But yeah. So you have whatever your adjusted gross income is after deductions. So you take what your 401k contributions are. Those are all pre-tax, obviously. So that's going to reduce your earned income for that year. Plus, you're going to have your standard deduction when you do go to file your taxes. So it's whatever your adjusted gross income after all of those deductions to your gross income. That's what they count, or that's what they look towards when they're determining your eligibility to make contributions to a Roth.
Yeah, that's right. So I have a number of clients that are sort of right on that borderline. I have a couple that are individuals, a couple of clients that are married. And so we have to wait until after the year, after the calendar year, reach out to the tax preparer and say, hey, let's do the calculations and see if they're eligible. So, again, another reason why some things that you should look at, that if you're right on those thresholds, you're going to have to wait until after the first of the year to make contributions for the previous year. You got to do that, right? Okay, so either one of you guys can take this one.
Well, I will say one other thing about that, though. If you're not near one of those thresholds, the best thing you can do, honestly, is just set it up on autopilot throughout the year. If you can build it into your budget, into your monthly budget, just to contribute X amount of dollars per month, that's going to be the absolute best thing for you. So you don't even need to think about these things.
Yeah, for sure. I mean, that's ideally. All right, so either one of you guys can take this. So we're all individual business owners, right?
Mm-hmm, correct.
And we have a tendency as business owners to wait until the end of the year, right? So we go through we
procrastinate too.
No, there are tax reasons you do this, okay? So and I'll go down a rabbit hole if I don't stop myself here in a second. But we wait till the end of the year, right? We find out what kind of year we had, and then we go meet with our tax preparer, and they say, okay, you can contribute X to your retirement plan. So that always happens after the first of the year. Now, could we be contributing a little bit throughout the year? Yes. But you really don't know how much you can actually contribute until after the year, right? Until after the first of the year. So touch base on when your deadline is to get your deposit in if you're a business owner. And I can touch base on it if you guys want me to.
Yeah, why don't you touch base on that
I'm probably weirding the question.
Definitely caught me off guard.
Right, so if you're contributing to like a SEP IRA, individual 401k, things like that, you actually have until your tax extension deadline to make a contribution to your company retirement plan. Now, there's a catch to this, okay? So as a business owner, you have, if you're individually, I have until September 15th September 15th to make my contribution. Okay. Now,
for the previous year.
Now, there are some ERISA guidelines that say you have to get a contribution in on a regular basis if it's for someone else. So if you have employees, you got to make those contributions throughout the year, or if you're doing payroll deduction, that's not what we're talking about. We're talking about an individual entrepreneur, solo practitioner, whatever you want to call it, single member LLC. That's what we're talking about. So as all of us are single member LLCs, all part of one larger entity, right? And there's lots of reasons why we do that. So if you want to know and you're like, I thought you guys were all together. We are, but there's reasons you do the single member LLC. But if that's the way you're set up, you actually have until September 15th to make your contribution. Okay? So I want to plug that in there because it's not April 15th. It's actually September 15th for individuals. Okay. With that being said, let's talk a minute about what Eric was bringing up a minute ago, and that is, so I didn't mean to throw really a big curveball at you guys. No. So let's talk about making contributions to an IRA or to a Roth IRA, and you make above the contribution limits, but you're still after January, right? We're still talking about things you can do after January 1, right? So we're still keeping in that theme. Let's say January 1 rolls around, you go, wow, I had a good year last year. I made above the contributions to my IRA, or I made enough that I can't contribute directly to a Roth.
Right.
Maybe we should only do one of these because I'm starting to get a little weird. All right, so
basically you make too much money, which is a good thing.
Yeah. All right, so let's tackle it from two perspectives. Number one, you make too much, and you have an IRA, existing IRA, but you still want to put money in that Roth.
Right.
What's the only way you can do it?
Well, that's the backdoor Roth. So you put the money into your traditional IRA. And most people would say, well, you would put money in there and then you write it off on your taxes. But in this case, we don't. And most of the people who have been phased out for the Roth, they've been phased out to deduct the IRA anyway.
Right.
So you just put it in there, you don't deduct it, and then you convert that. And what most people will do is whatever their contribution was for that year, they will convert 100% of that each year. So you're only really responsible for the taxes on the growth of that during that 1 year. Once it goes into the Roth, it stays there forever.
Yeah, but
Until you're ready to take it out.
Yeah, so Eric, I'm gonna come to you in just a second, but what you're saying is, and how I probably do 30 of these a year.
Yeah.
And we all do them at the beginning of the year, except for those that we're not sure that are right or borderline, and you got to wait a little bit to get the tax. Anyway, long story. So what you're saying is that you have an IRA set up, and you have a Roth IRA.
Correct.
And I think this happened in George Bush's tax reform. I think that's when all this started.
I believe that's right. Yeah.
I think that's right. Somebody will probably say I'm wrong, but I think that's when it started. But anyway, what you have to do is what you're saying is you move money from your checking account into your IRA first.
Correct.
Because there's no income limits for that.
Right.
But then you move from the IRA over to the Roth.
Right. That's called conversion.
Right.
It's a taxable event, but in this particular case, you've never written off the contribution in the first place. So the only thing that you really owe on is you owe income tax on the growth that occurred that year.
But if you do it like how we typically do it, we put the money into the IRA, wait a day or two.
Bingo.
Then it automatically moves into the Roth, and there's no growth or anything.
Exactly.
So there's
unless you just have one of those banner days.
I was going to say, unless you had a heck of a good day or two.
Well, but
market,
we typically just move in cash, so cash just sits there.
That's
and then
exactly
it
right.
moves over, and then you invest in all that good stuff. All right. So here's a question, Eric, to you. We run into this occasionally. Client comes in and says, "Hey, that's one of our partners walking in. I just said, hey, I thought it'd be nice." So client comes in and says, "Hey, I want to contribute to a Roth." They make too much money. They've rolled money out of their current 401k into an IRA at some point. So now they're stuck with money in an IRA.
Traditional
IRA.
Correct, yeah.
They still want to make a contribution to the Roth. Now they have to move money out of that IRA, and what happens?
Well, it's a Roth conversion, so you're converting money from your traditional IRA to a Roth IRA.
Yep.
Now it's fully taxable.
It's taxable
on
there,
whatever you convert.
Yep.
So this is when we need to do a little bit more advanced calculations in regards to what your total income is, because if we're going to do a Roth, it's fine, and for most of the time, it's going to make a lot of sense to do Roth conversions. But you want to be careful about how much you convert in any individual year, because let's say you are right on the threshold of going into the next tax bracket and you have $100,000 that you want to convert. Well, if you convert the entirety of $100,000 in your traditional IRA to a Roth, that's $100,000 that you have as earned income, ordinary income, that you need to pay taxes on. It's fully taxable.
Yep.
If that bumps you up into a new tax bracket, you know that you're definitely going to be paying more taxes at that point. So we need to be cognizant of how much money you're currently making, how much you're going to have in your adjusted gross income, and how much room. That's going to determine how much room we have, how much runway we have to do Roth conversions in any individual year.
And that's called a filling the bucket strategy. You hear people talk about that.
Fill the tax bucket.
Yeah, fill the tax bucket.
That's right. I will tell you, he's big on this bucket strategy.
Buckets, man. I'm all about buckets.
We were doing something the other night, and here he goes with the bucket strategy. Started drawing on the board. Hell, he had me so damn confused. I didn't know what he was drawing. But everybody else in the room got it. They're all shaking their head. Oh, yeah, I get that. I'm like, okay, whatever. Continue on with your
all
buckets.
about the buckets.
Anyway, but yeah, so that's the point. So I guess the point of all this is after the first of the year, up until April 15th, for the most part, right, there's some things that you should be doing. So right now is a good time. This should come out around the first to mid of April. Now, what's interesting this year, you have until May 17th to do any of this stuff. So if you're sitting around going, well, I got $1,000 sitting in my checking account, I want to invest it. You can open up a Roth IRA and still make that contribution for last year, for 2020.
Right.
I
want to add one thing to this discussion while we're at it, because I've had some people come in from time to time that they're contributing to a Roth IRA and their income goes up significantly. And now they don't qualify and they panic a little bit. Wait a minute, I put money into a Roth and now I find out my income was too high and I'm not allowed to. That's not a panic situation. You can fix that. It's called recharacterization, I believe is the correct word for it. Mm-hmm. But when you're working with your tax professional, they can direct us exactly how much to do that, and it's not a panic thing.
Yeah. Well, I mean, I've had that happen over the years. So
People get a little bent about that one because they just don't know what they're supposed to do.
yeah, and that's typically why we like to wait until after the first of the
Yep.
year. There's lots of strategies around that. You can accumulate cash in other accounts, and then after the first of the year, make that contribution. So with that being said, anything else you guys want? Any other comments around that?
I will add one thing around Roth conversions. It's one thing to also be aware of how much money you have in cash to be able to cover the tax liability of anything that you do convert. So like I said, if we convert $100,000 and let's say you're in the 25% tax bracket, you have a $25,000 tax liability. One thing you do not want to do most of the time, this is going to be a general rule of thumb, is you don't want to deduct the taxes from whatever you're converting because you're losing at that point the investment power of the tax deferral, the tax deferral and the compounding growth. So we want to make sure you're also sitting on an appropriate amount of cash to be able to cover that tax liability as well.
Yeah, so I guess the moral of that story is there are some things that you can do. So sit down with an advisor, come see us and say, hey, I've got a little extra money. I want to know what to do with it. Maybe there's some things you can do for last year you can do even this year. So that's kind of the moral of the story. If you and by the way, Chris wanted us to point out our socks.
Yep.
So we are kind of a sock group. Well, except for Eric.
Eric is
Eric's
really
not going to show you his
really
leg.
slacking.
There's nothing to show you today.
Yeah.
I wasn't planning to be on camera today, so.
Yeah, well, yeah, we really just kind of threw this together today. But anyway, so as we do these videos and we do our podcast, make sure you check out our socks because we're pretty colorful in that aspect.
Send us in your votes for who you think has the best socks on. We can have a little contest on our end.
We could, yeah. Mine are pretty. I actually just bought some new ones, so mine are.
I think those are pretty good.
Mine are mine are fresh, and I got.
We got to work on your shoelace game, though.
Well,
You're wearing buckles. You can't put in colored shoelaces.
Well, that's true.
Man.
That's true. All right, so here's the thing.
Eric's got his feet under
This
the table
podcast-
right now.
They'll stay there for today. Yeah.
All right, so this podcast comes out every 2 weeks. So make sure you tune back or check back with us for this particular podcast. It's called Peace of Mind Radio Podcast. We strictly talk about financial information. That's what we do on this podcast. Pretty simple and straightforward. We pick a different topic, talk about that, discuss it, kind of give our thoughts on how we work with clients on it. We also have another podcast called Connecting the Commonwealth, which we're getting ready to shoot here in about 10 minutes.
Yep.
So we kind of need to wrap this one up. But
And you'll see me in the same outfit in
You
that
see
one.
him in the same outfit 3 weeks in a row. Anyway, no, but that one's a really cool one. We talk strictly to entrepreneurs and other small business owners in town. So it's nothing about us; it's all about them, and we promote their services. So if you are a small business owner and you catch it and you go, "Hey, I wouldn't mind you guys helping me promote my business or my service or my product or whatever it is," make sure you reach out to us. Send us your contact information. We're happy to reach out to you as long as it's legal. We're good. That's supposed to be
And the
funny.
B&B one.
I know, I'm getting there. I
talk-
said as long as it's legal, and nobody even chuckled at that. Anyway, we also have a third podcast we do called Bourbon and Burgers or Burgers and Bourbon. We are going to wind up simplifying that to B&B because it's going to be easier to say. But it's a really, really fun one. We review burgers from locally in town and also bourbon. So that comes out every week. So we do a burger one week and a bourbon the next week. So check those out, and I'll let Eric sort of send us off, but that's it for now.
Yeah, well, thanks for listening. Make sure you take a moment to obviously listen, but make sure you're also subscribing to our podcast via YouTube or whatever, whatever platform you're listening to us on currently. So listen, subscribe, give us a rating if you can on Apple Podcasts, and leave a review as well. That greatly enhances our ability to be seen elsewhere. So once again, thanks for your time, and thanks for listening.
Have a good week.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal-related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.